looking to self-direct because you believe in hard assets like real estate or precious metals, or maybe you're a crypto investor, or you like private equity or venture capital. I mean, whatever it is you like, you want to get exposure to that and just use the retirement account structure for it.
Now, quite possibly, it might be the greatest wealth building vehicle on the planet when it comes to retirement plans.
We're going to hit the top 10 most frequently asked questions people have about self-directed IRAs. That's right, IRAs that can invest in real estate, private companies, crypto, startups, private funds. These are all assets your IRAs can own. And you probably got a bunch of questions about it and how it works. But that's our goal today. Nate and I, we've been both doing this for a decade plus.
Yeah, we're old guys in this industry.
We kind of are, huh? But we've had tons of calls with clients over the years, people who have been self-directing their IRAs, and we've learned a lot. And we've learned what you need to know, how it works. I wrote the #1 book on this subject, the Self-Directed IRA Handbook, and we have the #1 company in the space, Directed IRA, helping clients every day do what we're talking about today. So let's dive in. I'm going to hit the very first question here. We got 10. We got 10 freaking awesome questions you need to know, but I'm going to hit #1. What is a self-directed IRA? A self-directed IRA is an IRA that can invest in any asset allowed by law. A lot of people think of IRAs and 401ks and they think of mutual funds and stocks and index funds. Those are things your IRAs can buy, but that's not all your IRA can invest in. Your IRA can also own a rental property, like the duplex down the street. Okay, it can invest in a private company, crypto. These are always assets that have been always available to your IRA. It's nothing new. So that's what a self-directed IRA is. So you've got to move from your brokerage IRA, your broker dealer, where they let your IRA invest in what they sell, over to a company that lets you self-direct your IRA. That's what makes it self-directed, because they let you invest in any asset allowed by law. And there's a lot more to it, but that's the basics of what's a self-directed IRA. What would you add to that in terms of like what it is?
I would remind people that self-directed really is just a marketing term too. So
True,
it is used loosely, so be careful, because I believe Vanguard has a self-directed IRA, but guess what it's self-directed into? All their wonderful mutual funds that they offer you. So
anything on our menu at Vanguard, you can buy.
The difference between us is we don't sell investments to our clients. You have to choose your investment. So that's why we use self-directed. But ultimately, at the end of the day, an IRA is an IRA is an IRA.
Yeah, and it could be a Roth IRA, a SEP IRA, a traditional IRA. You could self-direct a health savings account, a Coverdell account. Okay, those are just different account types. We're going to be talking about generically here, self-directed IRA. But the self-directed means you're in control. You have unlimited open architecture investment options.
Can I add one more thing?
Yeah.
You can also have as many IRAs as you want. So a lot of our clients have a brokerage IRA, but they also have an IRA here that they can self-direct and invest into other investments you can't find at your Charles Schwab's and your Fidelities.
Yeah, even I have that. I have my self-directed IRAs, I have a brokerage IRA, and I think that's very, very common. And, you know, whether you're looking to self-direct because you're wanting to diversify, you're looking to self-direct because you believe in hard assets like real estate or precious metals, or maybe you're a crypto investor, or you like private equity or venture capital. I mean, whatever it is you like, you want to get exposure to that and just use the retirement account structure for it. And this is a big topic because there is $40 trillion in U.S. retirement accounts. And you want to know where the biggest section of that is? You know where it is, right?
Retirement accounts.
Yeah, but it's IRAs even within
now.
it. Yeah, so like within 401ks, a lot of people think 401ks are big. It's actually IRAs already. Yeah. All right, so that's the self-directed IRA. We love talking about it here every day. We're going to get into more details on here and what you can do.
Okay, most common question number 2, what can my IRA invest in? And these investment options have been around since the mid-70s when IRAs were created, but IRAs can invest in literally almost anything except for 3 investments: life insurance contracts, collectibles, and S corporation stock. Outside of that, your IRAs or your 401ks can own anything pretty much you can hold title to. So things like real estate, notes secured by real estate, investments into private companies, oil and gas, mineral rights, livestock, land. I mean, the list goes on and on and on. So as long as it's not life insurance, collectibles, or S corporation stock, your IRA can own it. You just have to find a company that's willing to hold the asset as your IRA custodian.
Yeah, and a lot of the big broker dealers, for example, say, well, you can't hold real estate in your IRA. It's not administratively feasible. What does that mean? That means you can't just type in a ticker in their system to buy stock. That's what they want you to do, right? It's easy. So like all this stuff, we don't want to handle it. So a lot of people are like, hey, man, I've heard about a self-directed IRA, and I called up Fidelity, and you said that it could own real estate, and Fidelity said I can't do it. Well, that's because Fidelity IRAs can't do it, okay? You need to get over to a self-directed provider that lets you do that. And real estate's always been available. It's always been on the table. But and real estate's the most popular.
Yeah.
Whether you're buying a rental, you're flipping a property, you're doing secured lending on it, you're investing in a private fund doing real estate is like 60% of the accounts. But there's lots of unique things like Mark, our co-founder, he's invested in cattle with his retirement account, you know. We have clients that owns a percentage of a professional Mexican soccer team. I've had clients own franchises in it. Obviously, on all the typical stuff that you hear.
Yeah,
like
I've had a client own a pineapple farm. I had another client own a thoroughbred. I mean, that's not something I would invest in, but that's the cool thing about self-direction is you can invest in what you're knowledgeable about, and we're not going to tell you yes or no. We're going to tell you, yeah, we hold it in the IRA, and here's how we're going to buy it.
Yeah,
I would say this is you don't have to be knowledgeable or an expert in real estate if that's what you want to invest in, because I find a lot of our clients invest passively through notes secured by real estate as a lender. They invest in syndications, apartments, short-term, mid-term, long-term rentals. I mean, there's a lot of different opportunities for you to diversify even your self-directed IRAs into different types of real estate investments. And
I think the point of this is you can invest in anything, and a lot of people are like, but what should I invest in? Invest in what you know. Yeah. That's always where we've seen clients have the most success, because I always have people come at me and like, well, Matt, what is everyone doing that's got the big accounts? You know, like I have one client's got a $400 million Roth IRA. They're like, what does he invest in? And I'm like, it's different. Everything he invests in is different than the next guy over here that's got the $100 million IRA. You know, he's doing stuff that's different. And so the large accounts that we have, they're not doing the same thing. They're doing what they know. And so that's the point here with self-directed IRAs. It gives you the ability to invest in what you know, what you believe in. You're not restricted to a little menu here of publicly traded stocks. Invest in what you know. And like Nate said, there's only a few restrictions here. And frankly, most people don't come here to buy life insurance, collectibles, or S corporation stock anyways. All right, the number 3 most frequently asked question we get about self-directed IRAs are, what is the prohibited transaction rules? Now, this is the number 1 rule. This is the most important rule you need to understand about self-directed IRAs. It's something called the prohibited transaction rule. This rule doesn't restrict what your IRA can buy. It restricts whom can my IRA transact with. So for example, if I have a self-directed IRA and I'm buying real estate, who's selling the real estate to my IRA? The rule is super focused on who's on the other end of the transaction. And what they're looking at is a certain list of people called disqualified persons. So you are a disqualified person to your own IRA. Your parents are a disqualified person to your own IRA. Your kids' spouses. Your spouse is a disqualified person to your IRA. And so, for example, if my IRA is buying a property from my dad, that would violate this rule and cause a prohibited transaction because my IRA buying property from my parent. So we always want to look at who's on the other end of the transaction. Now, real estate's the easiest. Let's say your IRA buys a property from your uncle. Well, that's fine. Your uncle's not on the prohibited list here. Totally fine. And let's say then that property is leased to your niece. Totally fine too, okay? Not on the list of disqualified people. But if you're like, well, I bought this property and now my daughter's living in it, well, that's going to cause a prohibited transaction because she's on the list of disqualified persons. So you want to know who's disqualified, and that's going to, again, be yourself. You're disqualified to your own IRA. Your spouse, for those of you in Utah, this is all of the spouses, okay? Your parents, your kids, and spouses of your kids. That's the disqualified person list. So always focus on who's on the other end of the transaction when you're thinking about a prohibited transaction. Remember, it's not about the asset. It's about who are you transacting with.
And the reason we talk about this a lot is because, first of all, this is a rule with all IRAs. They just don't have to talk about it at Fidelity or Charles Schwab because you're just buying assets from Wall Street and financial products. But when you self-direct, you're dealing in the private market. So it's just important to understand who's prohibited, who's disqualified to my IRA. And as long as you don't transact with those people, as long as your IRA doesn't transact with those people, then there's all sorts of possibilities.
Yeah, and if you do have a prohibited transaction, by the way, in your IRA, and let's say you have a $200,000 account and you engage in a $10,000 prohibited transaction, the whole account becomes disqualified. It's distributed out. You have early withdrawal penalties if you're under 59 and a half, goes in your taxable income. We don't want a prohibited transaction, all right? So you need to make sure you understand that rule and you don't violate it. Now, there's a couple varieties of additional prohibited transactions. One would be what's called a self-dealing prohibited transaction. And that's when you get personal benefit, or any disqualified person gets personal benefit because the IRA transacted. So for example, let's say you have an IRA and you're buying real estate and you happen to be a real estate agent. So you get the buyer's agent commission. Let's say it bought a piece of property for, 200 grand. And you're like, well, I'm getting the buyer's agent commission of 3% on that 200 grand. I'm making $6,000 personally as a commission. Well, that's going to cause self-dealing because you're financially benefiting because your IRA made an investment. So there's other varieties of this self-dealing you got to be careful and know about. There's also an extension of credit prohibited transaction too. Yep. You want to go over that one?
Yeah, so, there's all sorts of creative ways you can use your IRA. And, one of the things is your IRA can actually borrow money to buy real estate. But one of the things that would make that prohibited is if you sign a personal guarantee on that debt. You have to get what's called a non-recourse loan. We could talk about that. But, those are the things that are prohibited. But here's what I tell a lot of our clients, Matt, is, you mentioned the penalties. The penalties are very stiff if you break the rules, but the penalties are stiff because the value of having the IRA grow completely tax-deferred or tax-free is so great. The IRS doesn't mess around with people that try to violate the rules with that. The IRAs and your 401ks are there to make investments, not to self-deal into your own. Your benefit comes from the distributions you take from the IRA.
Yeah, so think of that as like long-term wealth building, and this is a retirement account where the government's like, you benefit from this when you're 59 and a half and you start pulling money out. Don't try and milk it right now by personally making money or buying an asset or a property that you go live in or something like that. That's not what this is for. Think of it that you're investing for investment purposes. The sole intent is to grow and build that IRA and make good investments, not to personally benefit from it today.
Number 4, how do I move my existing IRA to a self-directed IRA? Probably the most common question we get on the phone here at Directed IRA is, how does it even work? I understand how to fill out an application, but how do I move the money? It's actually pretty simple. Anytime you're going to transfer an IRA from one company to another, you fill out the transfer form of the receiving custodian. In that case, it would be us. You fill out a transfer form, we either fax or send that transfer form to your Fidelity or Charles Schwab, and they're going to wire those funds over to us at Directed IRA. One thing important to know is this is not a taxable event. I get that question a lot. Is that going to create taxation for me by moving it from Fidelity to you guys? Transfers aren't even reported to the IRS. The IRS doesn't care about you moving your IRA funds from one place to another. So all you got to do is fill out a transfer form with Directed IRA. We send that transfer form to your current custodian. You can transfer whatever amount you want. You don't have to transfer your entire IRA. You can transfer a portion of it. And I would say one thing that we try to tell clients to keep in mind, make sure your assets are liquidated and we're moving cash. That's one of the important things. That can slow down the process if we're trying to move stock. Just liquidate as much cash as you want to transfer, and we'll transfer that cash simply by just filling out a transfer form.
Yeah, because everybody comes over to a self-directed IRA because they don't want to go buy a new asset, right? So sell out of the mutual fund or ETF or stock that you're in at your brokerage IRA to get the amount of cash you want, whether it's a partial amount and the rest is invested or it's the full amount, and then we just transfer over that. Now, transfers work in about 3 to 5 business days. Every custodian's a little different. The Fidelities and Schwabs and TDs are a little faster, actually. If you got a credit union IRA, that might take a little bit longer, right? Because they're going to send a check by Pony Express, and then we got to hold it, and it'll take a little bit longer. But this is the most common way people come to a self-directed IRA. A lot of people are surprised. There's $15 trillion in IRAs right now alone. Most of those are in brokerage IRAs, but a lot of people are coming to self-directed IRAs, and that's where most of them come is from an existing IRA already. There's more money in IRAs actually than 401ks, and so they're already coming over from an IRA. But that's the process, is transfer. All right, number 5 most frequently asked question, how do I move my old employer 401k over to a self-directed IRA? Now, this is a common question we get because a lot of people have money in old 401k plans and they can move it. That money is accessible. You can move it wherever you want. You want to go to a broker-dealer IRA, you want to go to a self-directed IRA and invest in real estate or other alternative assets, you can move that account whenever you want. Now, the process is a little different than what's called an IRA transfer. So this is going to be called a direct rollover, and you're going to complete a form with your old employer 401k plan provider. That form is going to say, hey, I want to move my money to a directed IRA or a self-directed provider. Go ahead and liquidate my account and send over cash to my new IRA provider. Now, you will actually get a 1099-R for this, but it's going to be coded by that old employer 401k provider to say that it is not taxable. So that 1099-R is going to come into the mail, January 31st of next year, but just know that is not taxable. It'll be coded that they send it to an IRA provider. So no tax, no penalty to move the old employer 401k over to a self-directed IRA. Now, most old employer 401ks are traditional 401ks, so you will need a traditional self-directed IRA to receive it. Now, some people have a little bit of combination of funds too, right? So they might have traditional 401k dollars and Roth 401k dollars. How would you do that in the rollover process?
Well, we got to receive it how it is. So if you've got some pre-tax dollars in your 401k, we need to open a traditional IRA to accept the pre-tax dollars. If you've got some Roth money in there, we've got to open a Roth IRA to receive those funds as well. So you'll end up having two accounts, but that's good. You've got some pre-tax and some post-tax dollars.
Yeah, and you could consolidate them into one if you want to convert that traditional over to Roth. Obviously, there's tax on that conversion. We got more to come on that. But that's how you get the old employer 401k over to a new self-directed IRA. Again, no tax, no penalty. It's called a direct rollover, and you request it with the old employer 401k, obviously communicating with your new IRA provider, letting them know that the funds are coming.
But be cautious with an indirect rollover. Now, here's the difference with an indirect rollover. An indirect rollover is if your employer is going to cut the check payable to you. Now, when that check's cut payable to you instead of directed IRA, there might be tax withholding. You're not going to get the entire amount. It causes a big tax headache. So if your intention is you want to move 100 grand from your 401k and have it be 100 grand over directed IRA, make sure you do the direct rollover. They cut the check payable to us, or they send the wire directly to us. They don't cut it to you.
Yeah, and if you did the indirect rollover, you've got 60 days now to get that money into an IRA. And this is presuming you haven't done a 60-day rollover before in the last 12 months. But if you do that, you can save that. So just know if you're in that scenario and you got the check and it was made payable to you, the clock's ticking. You got 60 days to get that money back into the IRA to avoid a distribution.
So direct rollover, indirect.
Yeah, don't go indirect. Don't do that. Don't be that guy. Okay, just go direct.
All right, number 6, most common asked question, can I self-direct my current employer 401k? Now, this is where it can get a little bit tricky now. Most companies, if you're an employee of that company and you're still an active participant of their 401k, there's going to be some restrictions in most cases to allowing you to move money out of that 401k while you're still employed. But if you've been there for, let's say, X amount of years, or you're above a certain age and maybe you're fully vested, it could be a combination of all three, you could ask your employer if they allow what's called an in-service rollover. It's just like the name suggests. You can roll money out a certain amount while you're still in service with the company. That wouldn't be for us to decide. You would just have to call your 401k provider, your HR department, whoever's managing it, ask them if you have in-service rollover options. And also with that, current employer 401ks, if you've moved old employer 401ks into that current plan, most likely you can move those funds out. But the contributions of the money that's been put in there while you're working at the current company, it might be tough unless you have in-service rollover options.
Yeah, and I think the two most common areas where you can do an in-service rollover is first if you're retirement plan age. If you're retirement plan age, and most plans set that at 59, some do it as early as 55, even though you're still working there, let's say you're 60, you can roll them funds out. That is almost automatic at most 401ks that you're able to roll out once you've hit retirement plan age, even though you still work there. The second one that is common is an in-service rollover of vested employer contributions. Now, I know it sounds weird, but when you put money in a 401k plan at your job and you've decided to defer that into the company 401k plan, they can lock that down and say, you ain't moving this until you hit retirement plan age or you leave. But the money that the company throws in as a match is compensation to you. And once it's vested, it's deemed your money. So a lot of 401ks say, hey, the employer contributions and matching that we threw in that is now vested, you can actually roll out. And so those are the areas where you can kind of pick at your current employer 401k and get some of the funds out if any of those scenarios hit you. And then also the one you mentioned, you had an old employer 401k you rolled into your current employer, that old employer 401k bucket of money could typically get rolled out too. So everyone else though, you're stuck. And this is the area where there can be a little bit of frustration because we get a lot of people excited about self-directing and they're like, damn it, I'm working at the same company. I got 500K locked up in this thing. And I seriously have clients be like, I think I'm going to quit and see if they'll hire me back next week. And I'm like, I don't know, man, that was a little risky. Just then I could roll it out and then I'll come right back and work for them. And I'm like, there's probably a lot of consequences to that. Oh, that's a great idea.
And if you hit that roadblock, don't be frustrated. Maybe think about some of the plans you have outside of that 401k. I have a lot of people that call us every day that have a 401k, but they have an IRA. They have a Roth IRA. They have a health savings account. Think about those other plans that are already in an IRA or something outside of the 401k, because those might be a little bit easier to move. And then maybe when you leave jobs or you retire or you quit and try to get hired back, then you can move the rest of the 401k.
Or just wait till you're 59 and a half,
There you go.
Hit that magic age. All right, number 7 most frequently asked question on self-directed IRAs is, what is an IRA LLC or a checkbook IRA? What an IRA LLC is, or a checkbook IRA, is an IRA that invests into an LLC, let's say 100%, and then that LLC goes and makes the investments. So let me actually whiteboard this here for a second. A lot of people are familiar with their IRA, and let's say it's buying a rental property, right? We've been talking about self-directed IRAs. Your IRA can own a rental property. It pays the money to buy it, and then the cash flow of the rent or the gain when you sell it's going back to your IRA. Well, you can do that. We have lots of clients here who use their IRA and it owns real estate directly. Many of them have a property manager to help them with the expenses. But the thing with this is this can be a little clunky. Even when I buy the property, who's on the purchase contract? It's not you. It's Directed Trust Company, FBO, Matt Sorensen IRA. The purchase contract's in the name of your IRA. You approve it. Your IRA custodian signs it. Then you're going to have to authorize the earnest money. Then you're going to have to authorize the final closing funds. Then you're going to have to authorize your IRA custodian to sign the final closing documents. It's a lot of paperwork and back and forth with you and your custodian. Now, we love you and we want to help you, and that's fine. You could do it that way. But most people, particularly real estate investors, like to have their IRA invest into an LLC, and that LLC goes out and buys the real estate. So now my IRA puts cash in an LLC, which has a bank account. This is the bank account. This is just an LLC checking account. We love Titan Bank. You can use whatever bank you want, but they happen to do a great job and know what the heck an IRA LLC is. So that money goes into an LLC checking account. Now you are manager of the LLC. You don't own the LLC at all, but you can be manager of the LLC. Your IRA owns it 100% in this example. Now that cash is in the LLC bank account. Now you're like, all right, I want to go buy a property. Who's on the purchase contract for the property? The LLC is. XYZ Investments LLC, or whatever you called the LLC, is the purchaser on the contract to buy the property. You sign the contract. You got to send the earnest money, send a wire, or cut a check from the LLC business checking account. There's rental income coming in once you close. That's going to the LLC. The gain from when it sells, it goes to the LLC. Now, you don't get to touch the LLC bank account. Remember, you don't own it. The IRA owns it entirely. But the nice thing about the LLC here is it puts you in this position of control. That's why some people do call us a checkbook control IRA, is because you're a manager of the LLC, you have authority over the bank account, you have a lot more control in actually administering and handling a deal that your IRA is doing. And for real estate, that can become very valuable. Now, if you're like, Matt, I'm just investing in a private fund, don't do that. Just have the IRA invest in the private fund. No reason to have this. But if I'm buying a rental property, the conveniences and benefits, plus a little bit of asset protection. If something happens on the deal, they have to sue the LLC. That's where we like using the IRA LLC or checkbook control IRA.
And we love to get stuff out. I mean, we have over 700 5-star reviews. We can get requests out in 24 to 48 hours. But if your investment has a lot of moving parts, if it's a heavy rehab, sometimes 24 hours is even too long. I know how you real estate investors work. It had to be sent out yesterday. So, and with that, I would say that greater control does come greater responsibility. So you should understand the prohibited transaction rules and how to use it responsibly. But if you use it responsibly, it could be one of the best tools on the planet for ease of use and partnering accounts together. If you're trying to bring in multiple accounts, I think it's really easy to put all those accounts and invest into one LLC where all the funds are in a bank account. It could be your Roth, your wife's Roth. You guys have traditionals. Maybe your kids have Roth IRAs. You got an HSA. If you got all those accounts that you want involved in that investment, it might be easy to just dump them in an IRA LLC and go from there.
Yeah, and here's another just variety of that when Nate was explaining there. Let's say you had 3 different people. I mean, let's say this is your account with $30K, your spouse's account with $30K, and your friend that's got $40K. You know, the 3 of you go into an LLC to go buy a property. You couldn't have done the deal individually, but we can combine the funds together to go buy a deal. Now we'll break up that ownership, 30%, 30%, 40%. We always break up the ownership in an LLC based on the dollars invested from the IRAs. Now that's called a multi-member IRA LLC, a little more complexity to it, but it does allow partnering and the ability to put multiple sources of funds, whether they're IRAs or individual funds, into one LLC to actually go and acquire the asset.
Now make sure too, when you want to take distributions for your benefit, it does not come from the IRA LLC. Those funds have to come back to us and you have to process the distributions through us. So again, and we give you a proper consultation when you set this up. So it's not like we just leave you out there on an island by yourself, but back to what Matt said, it's not something that everybody needs. If your investment is very, very straightforward, I would even say some note investments. If you're loaning to a borrower that's buying a property, they're fixing and flipping, and you're going to have the money back in 6 months, you probably don't need an LLC for all that.
Yeah, I mean, I even invest my own IRA in private notes right now, and like every few days I'll get a text, hey, I got a deal for this, and I'm like, I'm busy, but I use an LLC, guys, okay? I use this structure. Like, I'm the CEO of the company, sit here, and I know the forms and the buttons to push, and the people go walk and tell what to do. I use an IRA LLC for my own deals because I do real estate transactions. I've bought rentals, I do private notes that might need funding on a short time frame, and the LLC is just super convenient. So think of it for a real estate investor. If you're doing syndications or other investments where the LLC doesn't provide a lot of convenience or benefit, you can skip it. Not everyone needs the IRA LLC.
Number 8, and we're going to get a little advanced here, but stick with us. What types of tax traps or tax hurdles might I encounter when investing through a self-directed IRA? Now, there is a tax that you should just be aware of. I say you don't be scared of it, but you should be aware of it. It's a tax called UBIT. It's called unrelated business income tax. This tax really kicks in to all nonprofit or all tax-exempt entities, not just IRAs. And what unrelated business income tax is there's 3 circumstances where your IRA can invest in certain investments that might trigger this tax. This is not a tax to you. This is a tax to your IRA. Okay, just real simple. The first example is your IRA owns a business. Let's say it's an operating trade or business. I picture it like this. If my IRA wants to buy a Pizza Hut, it can buy a Pizza Hut, but it would be unfair for my IRA-owned Pizza Hut to sell pizza cheaper than the other Pizza Huts because I pay no tax on the income. The IRS says, no, if your IRA owns a business, an operating trade or business, and there's ordinary income, we're going to tax the IRA just like we tax a business owner. That's number 1. Number 2 circumstance is if your IRA owns and leases personal property. Just think about personal property. It's anything not tied to the ground. Boats, jet skis, automobiles. For real estate investors, mobile homes not tied to the land could be considered personal property. You might have this tax, unrelated business income tax, kick into your IRA. But the most common one that we see is called unrelated debt finance income tax. And this is where we get a lot of questions on it. We do a lot of education on this as well. Unrelated debt finance income tax comes from when your IRA borrows money to buy real estate. Okay, it's unrelated debt finance income tax. The important thing about this tax, you want to think about it as a cost of doing business. There's an analysis to whether or not you even want debt on an IRA-owned property. But I have a ton of stories about clients utilizing debt to either buy more real estate, increase their cash-on-cash return. But I think that most people just hear tax and IRA and they get gun shy. They go, wait, I thought this was going to be tax-free to me. So, there's certain circumstances where even owning a business could be a great investment. Just because your IRA might encounter this tax doesn't make the investment bad.
Yeah, and I think the best thing to look at, and we talked about this earlier, is just what's the cash-on-cash return? Like if my IRA puts out X amount of dollars, what return back do I get on that? And if you think of using debt so you can buy more assets, that's going to create more revenue. Sure, you pay tax, but the way this UDFI tax works is actually only on profits from the debt. Let me just give a quick example here so you can see it. Let's say you bought a property for $100K. Let's say $40,000 of that came from the IRA. And let's say $60,000 of that was debt. Now let's say 2 years later you sold the property for $120,000. Let's say you had $10K in expenses, so you really took home a $10,000 profit in 2 years. Okay. Now when you look at that $10,000 profit in 2 years, at first you might think that's not that great off $100,000. No, your IRA invested 40, guys. Okay. First of all, your IRA invested 40. Okay. So that's not a bad return actually. That's a little over a 20% return. Now I said over 2 years, so but just hang with me here, okay? Now let's calculate the tax. Now when you look at the tax here, the IRS looks at this and says, hey, 60% of this deal was not IRA money. It was debt. So 60% of the profits get subjected to this tax. 60% of the profit here, $10K, $6,000. Now, when you sell the property and you're paying this UDFI, you get long-term capital gains rate of 20%. So the UDFI tax here is going to be $1,200. So really, I made 10, but I took home $8,800. That's what went back into my IRA end of the day. So when you look at the cash-on-cash return, you always got to think of what's the total return I'm going to make. I know we don't like tax. Trust me, I'm a tax lawyer by heart and trade. That's like I did it for over a decade. But if I can make greater investments than what my IRA is doing in the stock market, why would I keep buying more mutual funds if I can get a better deal by investing in real estate using leverage? Another way to think about it is, and I remember this call of a client who said, hey, Matt, I can buy 3 properties. They're about $120K a piece. I can buy 3 with a non-recourse loan, or I can buy 1 with cash outright. What should I do? And I'm like, do you think these properties are going to cash flow well and appreciate in value? Absolutely. That's why I would buy 1 or I would buy 3. Well, go ahead and buy 3. You're crazy if you're like, no, I'm not going to leverage with debt because I might have to pay tax. You're only paying the tax. And by the way, it's only 20% on the capital gain when you make money from the debt. Okay. And you get to keep the other 80% of it. So don't get gun shy on it and get freaked out about it and pass up the opportunity to buy more assets and leverage your retirement account. When your IRA is sitting back here at TD Ameritrade and you have $100K in it, guess how much stock you can buy? $100K worth. But you know how much real estate you could buy? $300K worth. But Matt, there's UDFI tax. Only on the money you make from the debt.
Yeah. And there's also ways
you get to keep the other 80%.
Yeah, and like with a lot of tax, there's ways to minimize it, there's ways to avoid it, and there's ways to even eliminate it depending on where that investment is. So, with any tax, it's just a calculation. I love your idea. I have an example of a client that bought 5 properties subject to the existing financing. Pace Morby teaches a lot about this. These were highly debt leveraged investments, but guess what he did? He just used the existing debt on the property so that his IRA, his Roth, only had to come in with $10,000, $15,000 to acquire these properties, and all he did was put those investments on the shelf and let renters pay down the notes. He hasn't sold the properties. Yeah. He's holding them until the notes are paid off. And in most circumstances, if there's no debt on the property in the 12 months prior to you selling it, you can actually pay 0 tax because there's no debt. So there's a lot of different strategies around it. That's why I always say don't be scared of it. Just be aware of it, because once you're aware of it going in, you can actually calculate it and use it to your advantage and see if your cash-on-cash return is a lot better. But like you said, you can't borrow money to buy stocks, but your IRA can borrow money to buy real estate, and that's powerful.
Yeah. So it seems like a no-brainer to me, but you got to know about it. Make sure you're understanding that. Now, one other thing I'll add on the UBIT tax before, as Nate described that, is the nice thing about UBIT is there's so many exceptions to it that are going to apply to you in real estate. Rental income on real estate is exempt from UBIT. Capital gain income when you sell an asset is exempt from UBIT. Dividend income when your IRA is invested in a C Corp. That's why when you're invested in a publicly traded company, you never worried about this because it's always exempt in a C Corp. But maybe your IRA is investing in a startup or other fund that actually has C Corp tax treatment. Maybe your IRA is getting royalty income or interest income when you're lending money. Maybe it's getting points. Those are all exempt from UBIT automatically. So the nice thing is that when you're thinking about investment income coming to your retirement account, it's generally going to be exempt from UBIT. Where we see it hit is the business scenarios that you talked about, where it's a trade or business. I see it sometimes with clients who are doing real estate development, or they flip a lot of properties in a year, more than just a few in their IRA. The IRS looks at that as being a business in and of itself, like your IRA is in the business of real estate, so they may hit you with UBIT. And then that last one here, of course, leveraging with debt.
The last thing I'll tell people is, remember, when you buy a real estate asset cash, there's no depreciation you use because there's no tax. Well, in the circumstance where you're using debt, now there is a tax. Guess what kicks in? You get to use depreciation now. So it's not the end of the world to leverage debt to buy real estate. Just turning your IRA into a taxpayer, guess what? IRAs get to use depreciation just like people do.
Yeah. And a lot of people are like, Matt, I don't want to buy real estate in an IRA because I don't get depreciation. Oh, no, there's depreciation. There's just no way for the IRA to use it when you buy real estate with cash. So in an IRA, because there's no tax, the IRA doesn't pay tax. But if you did leverage it with debt, that depreciation expense can be used to offset this UBIT or UDFI tax. Question number 9 that we get, should I use a traditional IRA or a Roth IRA when I'm self-directing? Now, you can use either. The most common account at Directed IRA happens to be a Roth IRA, and there's one reason for that: tax-free distributions. Your money's growing tax-free as you're building a Roth account, and you distribute it when you're in retirement. It's coming out totally tax-free then as well. Contrast that to a traditional IRA, which you got a tax deduction when you put the money in, And now you're investing in growing it. You don't pay tax as you're building it. But when you pull money out in retirement, you're going to pay tax on the way out. So you can self-direct either. I want to be clear on that. We have tons of traditional IRA accounts. Even I have some traditional accounts left. By the way, this is my last year with them. I'm converting them to Roth. But it's up to you. And don't overcomplicate this question before you self-direct. Just decide what lane you want to go in. Now, a lot of people come to us with traditional dollars already. And they're like, but I want to do Roth. Okay, you can convert. So we can convert your traditional 401k or your existing traditional IRA over to a Roth IRA before you self-direct. You're going to pay tax on the conversion. So if it's a $100,000 account and you want to convert it to Roth, you can do that. $100,000 is going to go into your taxable income for the year when you convert. But the nice thing is now that $100,000 is growing and it's going to come out tax-free later in retirement. So if you can turn that $100K into $1 million Roth IRA by the time you retire, you've got $1 million coming out tax-free later in retirement.
Now, keep in mind, there's no penalty for conversion. You just have to pay the tax. So obviously there's maybe some years it's better to do a conversion if you're in a low income year. Maybe you just left your corporate job, you go full-time, investor, I don't know, but maybe you've got some losses. Maybe you can convert in a low income year versus a high income year. But I will say, I think the ultimate decision maker, at least for me, is what are you going to invest in after you convert? That's really the end game right there, is once I pay this tax, what's my Roth IRA going to invest in? And is the tax-free growth more of a benefit than the tax I just paid? Because even high income earners, I had a guy that was a house flipper that converted $200,000 from a traditional to a Roth, his entire traditional. Mm-hmm. He was already in the highest tax bracket. Yeah. The reason he did it is because he found a motivated seller on a flip in a neighborhood. He had already flipped 4 properties personally. So he knew he was walking into a good deal. He knew he was buying the asset for below market value. He knew what he can flip it for. And he wanted that return to be tax-free. So he ripped the Band-Aid off. He did the conversion. He paid 37+% on the conversion. But when he flipped the property, guess how much he made? 72% return on that flip in 6 months. So for him, again, it's a mathematical analysis. If the tax-free growth outweighs the taxes you pay, then it's ching, 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 ching. He went on to do 3 more flips and turn that $200,000 into $600,000 pretty fast, tax-free.
Yeah, bless him. And I have the examples too, and this is the number one scenario where it's a no-brainer to convert to Roth. I had the client with the $10,000 Roth IRA, which came from a conversion of traditional funds, converted 10, and used that to get an option on a property that he sold 3.5 years later for over $1 million. So on a 10,000 conversion, he converted it, and the gain and appreciation of that property, which the client was a sophisticated investor developer, he knew what was going to happen there, went over and he sold that option for $1 million profit. Now he's got a $1,010,000 Roth IRA, right? And that's coming out totally tax-free. Now, if he kept that as a traditional, remember, that's going to be a $1,010,000 traditional IRA that you're going to pay tax on the way out. So that's why we're saying if you're getting significant growth, which a lot of self-directed investors do, there's a lot of sophisticated ones that can get home run deals like that. That's not Matt Sorensen, by the way. But if you can still get above 10 or 12%, I think it always makes sense to convert to Roth. If you're like, Matt, I'm getting 5 to 6, 7, 8% in the stock market, should I convert to Roth? Depends. You win some, you lose some. What are tax rates going to be at retirement versus what you're making now? But if you're like, no, Matt, I'm going to get 12, 15, 20% plus returns, it starts turning into a no-brainer because that money is multiplying at a higher rate, which is going to create a larger balance that's going to come out in retirement totally tax-free, as opposed to being traditional dollars where you're going to get pillaged and plumaged by the IRS on the way out.
And the other thing is when you get into alternative assets, you find that some alternative assets have multiple streams of income. With real estate, you got appreciation, you got rents. I mean, there's a lot of factors that factor into why people even like alternatives. If you're setting yourself up for a true retirement, owning assets with multiple streams of income and monthly income in a Roth IRA with qualified distributions, you're off the grid. The IRS can't touch you. You could take tax-free distributions for the rest of your life, and even better, when you die, that Roth IRA with those cash flowing assets just go to your beneficiaries, and they get to take tax-free distributions for another 10 years of the same assets, where on the flip side, if it's a traditional IRA, you got to start paying RMDs, you got to start selling assets just to pay Uncle Sam. I mean, it's harder to preserve wealth in a traditional IRA than it is with a Roth IRA, and pass on more wealth through a Roth IRA. It's much easier.
Yeah, so best lesson is here, you can self-direct either a traditional or a Roth. If you love the tax-free wealth and building wealth that way, think of the Roth account. It is the number one account at Directed IRA.
Okay, number 10 most commonly asked question, what is a self-directed solo 401k? Now, quite possibly, it might be the greatest wealth building vehicle on the planet when it comes to retirement plans. But what is it? Who can have it? First of all, a solo 401k is specific for people who are small business owners. Maybe you work for yourself. You don't have any common law employees, so those W-2 employees, right? Could be a CPA, you work for yourself. You could be a real estate broker. You could be all sorts of things, a mortgage broker. You work for yourself. This solo 401k allows you to self-direct. You have a little bit more control, but the benefits of the 401k can outweigh an IRA with the larger contributions you get to a solo 401k. Yeah. There's a tax exemption to the UDFI tax that we talked about on the previous video.
Yeah, and like the contributions are pretty awesome because you can put $69,000 a year into a solo 401k versus $7,000 a year in an IRA and new contributions. So we get a lot of self-employed clients who are like, Matt, I never had a 401k at a company that had a match that I just had to fill out a form and enroll in. It was all up to me, and I never even heard of a solo 401k. I didn't even know I could have one. Well, this is for you because you can put $69K a year in it. You can have traditional dollars or Roth dollars. You can pick. That could be $69,000 all Roth dollars if you want, or that could be $69,000 all traditional dollars, or you can mix it up a little bit. But the nice thing about the solo 401k is it allows you to put a lot of money in because you happen to be the employee in this scenario, so you're making employee contributions, plus you're the employer. That's how you get up to the $69,000. And since you're such a great employee, why not just give yourself this awesome matching in your own 401k? It's just you in there getting the perks.
Yeah, and there's other perks to it too. If depending on how you set it up, you can actually have checkbook control with the solo 401k. So if you want the access to the checkbook and actually disperse, funds out of the 401k to make your investments, well, you've got the checkbook as the administrator of the 401k. There's also the provision to take the loan if you need it for emergencies, yeah. just like any 401k. If you need to use that, you can actually take a loan from your 401k. You can't take a loan from an IRA.
Yeah, and the type of loan Nate's talking about there is a participant loan where you loan yourself money from your own 401k. Obviously, your 401k can make self-directed investments and lend other people money on real estate deals, just like your IRA can do. But there's this thing called a 401k participant loan where you can lend yourself money from your own 401k. So we have some clients that will roll over money, frankly, from an old 401k, do a solo 401k in their new business, and then they take a loan to themselves of $50K to help fund the new business or living expenses or, as they start to cash flow that business. And so that's a little unique option in a solo 401k that you can't do in an IRA. It's just that participant loan up to $50K.
Yeah, but the large contributions, the control, the fact that you can self-direct it, you can invest in all sorts of things, real estate notes, cryptocurrency, the list goes on. It's a very, very powerful tool and probably the easiest way to stash money somewhere where Uncle Sam can't touch it and be able to invest in the things that you know best.
All right, well, we did it the top 10 most frequently asked questions on self-directed IRAs. Thank you, Nate. It's a pleasure to be with you today. We've got so much more to learn on this, and please get over to our website. We're always doing monthly webinars. Nate's doing workshops. I'm doing webinars. Make sure you're subscribed to the podcast. We got a full-day self-directed IRA summit. We got an alt asset summit. I wrote the #1 book on the subject, the Self-Directed IRA Handbook. We have no shortage of education because we want you to be informed when you're self-directing your IRA. Not because it's complicated, guys. Self-directing your IRA is not rocket science. I always tell people it's like playing a freaking board game. You just need to know the rules before you go and do it. So that's what we're here for. We're trying to give you tons of education here on the channel, on podcast, over at directedira.com. And thank you for tuning in. We will see you next time. Until then, stay calm, self-direct on.